This is the Real Estate Investment Club at Intel. The date is October 30th, 2020. And today our guest is Mike Taravella. Mike, did I get your last name right?
Nailed it.
All right, perfect. We're going to go do a couple of announcements first, and then we'll turn it over to you.
Perfect.
People are still trickling in, so people will be trickling in, I guess. We've got around, I think, let me check really quickly here. I think we have 251 people registered, and we tend to get about a 60% turnout. So,
okay.
Yeah.
People are celebrating Halloween a little bit early, trick or treating, so it's okay.
That could be.
They'll watch the recording.
All right. The first thing I wanted to say is if there are any members of the Real Estate Investment Club steering committee on, or the leadership group, I know during our weekly meeting, quite a few of us said that we were going to be out, but it was also suggested that we should just give a moment here for the people that are making this club happen to introduce themselves. So hope I'm not embarrassed and none of the other people are on the line. I actually don't see any yet. So maybe we'll hold that over to next week. I know at least 4 of the 6 said they weren't going to be here. So for traveling and for other reasons. All right. And then the next thing that I wanted to do, I'll share my screen really quickly. All right. I wanted to let you know that we have 2 new members of the leadership group. We have Clinton and Megna. I'm going to be putting their names inside the SharePoint site where it says the leadership group and just an introduction to each of us. They can introduce themselves next week. One thing that Clinton brought to the discussion was, hey, we have this weekly discussion group that's going on. We get a couple of people every week. But maybe it would make more sense to create topic-based breakouts. And so can you go to Yammer and go to our real estate community? I'll drop the link inside WebEx in just a moment, as soon as I'm done talking. And let us know if you would be interested in one of these breakout groups. So we've been talking about a breakout group for rental houses, a breakout group for syndications, breakout group for fix and flips, and one for alternative asset real estates. And pretty much that would cover everything else from, self-storage to Costa Rican farms, mobile home parks, anything that isn't big enough necessarily to have its own group. That might include office parks, medical parks, other types of real estate as well. We don't sell any bridges though. All right. Let me switch it over to Mike. Yes, I can. Who's there?
So, this is Rohan, Daniel.
Hey, Rohan, go ahead and introduce yourself.
Yeah, so sorry, I was having audio issues. I was trying to say hello, but I guess nobody was able to hear me. So yeah, hello everyone. This is Rohan. I help out Daniel doing a lot of the backstage work at the real estate investment. It's been a really helpful resource for me. Right, and like from the very basic stuff all the way to a lot of advanced things. I encourage everyone to participate and get involved in discussion. With the community grow, it helps us learn and make new investments. So welcome to the club and looking forward to some great
All right. Mike, I think we'll turn it over to you now.
Awesome.
Let me unshare my screen and
let me try to share my screen. Alrighty. So we'll get.
Oh, and one quick thing. Do you want me to So I'd be glad to look at the chat room for you and just watch all the questions that come by, so you don't have to do that. You can concentrate on your presentation. Do you want me to interrupt you at a timely moment if there's a question? Either that or we can hold them all to the end.
You can rapid fire, go with it. I like interaction, right? So anyone can, ask questions. I'd rather people ask questions so that they know instead of having wait to the end.
Okay.
But
you want to open it up? Do you want to say that people we've got almost 100 people in the room. Do you want to say people can just break in audio wise, or you want to keep it to the comments box?
I usually ask after every slide if anyone has questions. We can open it up and make it as interactive as you want, as anyone wants. So if
Excellent.
but yeah, thank you so much, Daniel, for having me too. I know we did a podcast together and have communicated, and I'm super excited to be here and just spend a Halloween weekend talking about real estate, asset management versus property management. For those who don't know, I'm Mike Taravella. I work for Rand Commercial Real Estate, Rand Partners. We are the investing side of Jake Stenziano, Gino Barbaro, also Jake and Gino, Wheelbarrow Profits, that community. We have about 1,600 units, assets under management throughout the Southeast. We have we have 900 units or so in Knoxville, Tennessee. We have about 700 in Kentucky, more specifically in Louisville and Lexington, Kentucky. And we're always looking to expand throughout the Southeast. But with everything going on, valuations have gone up. And our three principles is buy right, finance right, and manage right. So we're just looking to expand. And I'm here today to talk about asset management versus property management. And kind of go through what we do on the Rand commercial real estate side when it comes to our rhythms. So, but first, I want to kind of just go through and see what is property management. So property management usually consists of the property manager, assistant property manager, leasing. It's the back office and the maintenance side. So these are your client facing for your residents that are handling the day-to-day operations of the property. So they're looking for, leasing units. They're looking for maintenance techs to fix stuff. So it's really important that these team members, because they are truly team members of your team, whether you use third party, whether you do it yourself, you're the representative for it. So it's important that these team members nail the customer service, but also the operations and the numbers piece. So that's the day-to-day of the property management side of things. And the asset manager sits on top of that to make sure, is our customer service being executed? Is our occupancy where it needs to be? Also, where are our numbers? Our income and other rental income, our other income fees like applications and admin and pet fees hitting our mark? And also, more importantly, our expenses. So it's really important as the asset manager. We call it a collaboration, because without property management, the asset manager can't execute because they're not the day-to-day, but they're collaborating together to make sure that they're executing the business plan. So whether you're, have one property and you have a third-party manager do it, or you have 100 units, it's important to make sure that you're holding each other accountable. It's important because if you're not holding your team accountable, then it'll show in the numbers, and then it'll show in your occupancy, and it just deteriorates very quickly. Not only the number side, but your community and your reputation, and it's just a downward spiral that can vastly affect your reputation, your investors, and those reviews come back to you. So look at it as the asset manager is having the tough conversations, but you have to build in those feedback loops to make sure that you're executing. So does anyone have kind of questions on, the difference between property management or asset management so far? I don't see anything in the chat, but I just want to make sure everyone kind of gets that, because it's truly a collaborative piece. So here are rhythms. So these are the best way to make sure that you're executing your business plan through and through is through these rhythms. And it's important to establish these on the front end, because what we see a lot too is, well, we checked our monthly reports and this didn't work. And then you're kind of trying to solve the problem. But if you have weekly and monthly and even annual rhythms, you'll always know where your property stands, whether you're being active or passive. So it's really important just to make sure you set these up on the front end and establish it. Because even too, I've seen a lot of people who leverage third-party property managers. We're vertically integrated, so we have our own property management in-house. But with third-party, they don't establish the rhythms on the front end, and then on the back end, it hinders the relationship and butts heads. But if you have it established and have the metrics lined up, then you're just kind of checking in, keeping everyone accountable, and so on and so forth. So our weekly document that we use is called the Pulse. So we call it the Pulse because we want to keep the pulse on the property and see what's going on. On a monthly basis, we review the income statement. We also compare it to the budget because we want to see any outliers that happen on the property, or is it consistent issues? So it's just important to check that. And lastly, on a monthly basis, we're reviewing the rent roll. This is important because you can see past due balances. And I think with collections being the number one topic during the pandemic, it's important to make sure which residents are paying, which ones aren't. Do they need a payment plan? Is there a rental assistance program that we can help them with? Because in the end, you as an operator, if you have investors, you're a fiduciary to them. So you have to look out for their best interests. So it's important. Our portfolio on average during the pandemic has been around 94 to 96% collected. And the biggest thing is we have a deep delinquency narrative. So every resident who hasn't paid or is paying late, we're following up, asking how we can be of service. Even during the pandemic, we gave everyone a roll of toilet paper and a note saying, hey, during these crappy times, Rand Property Management is here to help serve. So it's important that we're just helping our residents through this time of need. And then on an annual basis, what we're doing is we're redoing budgets. Q4, I'm sure some team members on this call are doing budgets and getting jazzed up for 2021. But we're doing budgets to make sure, reviewing what we did well the past year, what can we improve on, and where were we off, and how we can get better. So those are the rhythms so far that we have that we use on a weekly and annual basis. So this is the Pulse report. This is what we use every week. So if anyone is looking for this document, I can send it to Daniel. It has looms describing each category and how we use it. So I'm happy to share this with you, Daniel, and the listeners on the call. But the first thing that we look at is the occupancy. And we use AppFolio as a system. And so the vacant unrented means that these apartments are still available and need to be rented out, versus vacant rented is, hey, they're currently vacant, but in the next week or so, they'll be rented out. So our occupancy rate is generally, as a portfolio, we're targeting 95%. A lot of properties, we don't have very few vacancies. In Kentucky, we have a little bit higher, but as a portfolio in the East Tennessee properties, we're looking for around 95%. So if this 95% isn't there, the next thing we're looking at is our leasing metrics. So as you see the guest cards, these are general inquiries about the property, whether it's an artificial intelligence system that we use called Lisa. She generates questions and gathers information on the potential resident, and then issues out whether or not they can schedule a tour. So a lot of people at our properties will go, oh, I'm looking for Lisa for the property tour. And then we have to tell them, oh, hey, it was an AI bot that was helping them through the journey. So applicants are the people who were guest cards and then converted into applicants for potential residents. So if our occupancy rate falls below that 95%, we're looking for this conversion rate of 30% to make sure that we're getting enough people, enough guest cards, and enough applications. So if we're not there, and we notice our guest cards in week 5 were below the average, we're reflecting on, is our apartments.com right? Is our Craigslist ads, Facebook Marketplace? What is not working that we need to revisit so that we can make sure we're executing our business plan? Because there's been times where apartments.com is down, or it's the wrong information's on the ad. So then we have to reassess and see what's going wrong. And I look at these Pulse reports as like a feedback loop, like a wave. If you're constantly getting feedback of, hey, our occupancy is where it needs to be, great, perfect. If not, you can quickly course correct, take the preventative action so that before the month ends, you can have your building occupied to your standard for your business model. So it's important to keep tabs on it every week just to see what it's going. A lot of times our properties has been good, but sometimes, we found out there's an error in the apartments.com and that's hindered our performance, or we need to try Facebook Marketplace a little bit more in the particular market. So this is where the collections can be helpful. The next thing we check out is delinquency. These are the biggest, with everything going on, delinquency is a big piece. This is the total past balance due. So if people don't turn in late fees, obviously rental income is a big piece, but we want to make sure all the money on the table, what are we collecting on? Like I said, our collection's been very strong during the pandemic of 94 to 96%, but it's good to keep tabs on each week how much is owed and see how much, compare it to past month and see if it's outliers. And then at the very bottom, we have our bank statement. So this is our income and expenses. This is important because we need to see how much we're processing. So with our investors on syndicated deals, we have an 8% preferred return. So it's important that we're generating enough cash flow so that we can be paying out this distribution. So constantly measuring the profitability along with all these weekly measures to make sure that we're constantly moving the needle forward and executing the business plan. I think I saw a question pop up, Daniel, or does anyone else have any other questions regarding kind of this slide or the weekly rhythms?
You want me to read the question in the chat too?
Yeah, I don't know where it, I saw it, but I lost it.
It's from Mohammed Akbar, and he is asking, can you comment on AppFolio versus Tenant Cloud? The latter is much cheaper.
I say I have not heard of Tenant Cloud, so I cannot speak on Tenant Cloud. But AppFolio, I know there's a lot of bells and whistles. The more, if you get the pro version, but AppFolio is, it's cheaper than Yardi. When you get it built enough size, I know Jake and Gino, when they first started, was Buildium, and then they evolved into AppFolio. It has all the reporting. I've seen some investors use QuickBooks, and I as a CPA, I would highly advise getting systems that develop the rent rolls for you and the collection reports, just because it'll save you, even though it might be the cheaper option, but go with a system that you're building up to, because anytime you switch systems, it is a pain point, especially with the numbers, because the last thing you want to do is get ghosted by your own numbers. So, but I cannot speak. Daniel, do you know Tenant Cloud or have used it in your systems?
I do not know Tenant Cloud.
Okay. So I can't, but I'm happy to, for AppFolio, if anyone has any questions too, or what it looks like, or is thinking about converting over, happy to, can do a demo or what we use it for. But there's a lot of good reports. Like any accounting system, you just need to know how to use it. And there's a lot of countless reports to pull from. So, but does anyone else have any questions on kind of the Pulse document? Or like I said, I can share this too with you, Daniel, to share with everyone else in there. And a lot of teams, and I think too, if you're, becoming active or you're looking to invest in a syndication, or even, a couple single families, it's important to have this. So then you're seeing the reporting and you can ask property management companies, what do you measure on a weekly basis? Because they can report it to you, but you got to understand where they're coming from. And if they don't have this feedback loop, they might not be the right partner for you. Every group is different, so I don't want to say this is good or bad. It's just how involved you want to be in. So every person's different. And then now on a monthly statement, we're looking at the income statement. So when we're looking at the income statement, you always, and this is what threw me off from being in a CPA to working in kind of the more financing piece, is the gross potential rent. So this is the total rent you could potentially charge at market rents. Obviously, the hardest part for me was that could be an arbitrary number. I could think rents are 1,000. Daniel could think they're 900. But it's just a measuring stick of where you think you can charge rents. We've reassessed rents probably every quarter, unless there's any major variances that we've found. We stick to quarterly. Every once in a while, it could be monthly, just especially when taking over new property. It's important to reassess. Then you subtract out your vacancy, so how many people are physically there and physically not there. And then delinquency, these are the residents who aren't paying. That gives you to your effective rental income. And then a component that we've seen that differentiates us is charging other fees. So we don't, and unlike I lived in Chicago for 8 months. So if you charge a security deposit and you don't return back the 8% or 8 cents of interest or 10 cents of interest, you go. There's residents or lawyers will help take the residents to court, take you to court as a landlord, and you'll have to pay 3 to 4x the security deposit. So we eliminate that by charging application fees and move-in fees on the front end. So it ends up being cheaper because, the dispute of fighting back, it's just a move-in fee on the front end. Obviously, every market's different, but we generally see our move-in fees are around half of first month's rent, averaging around $450. So it's great to see increasing the income by charging a move-in fee, and then you can recognize that as revenue instead of kind of IOU later and potential disputes with the residents. And we've gotten good feedback on that, and we've seen our other income represent probably 10 to 12% of our total income. So it's a great way to. We've seen a lot of properties that not charging pet fees and stuff like that. So when looking at multifamily or any real estate asset in general, it's important to see what other fees you can implement, but you have to really make sure that you're doing what the market's doing. You can't be the only person doing it, because then you might get some pushbacks from the residents. And admin expenses, these are your office and legal expenses for evictions. Labor, it's whether it's you have payroll if it's a big enough office, or if it's contract labor, so people who are painting, people who are cutting grass, so labor. Insurance is one expense that has gone up. We have seen a lot of properties charge a lot more in insurance lately, especially due to natural disasters, flood zones. We're averaging around $300 a unit for insurance expense, but we just got our premiums back, and one of our properties went up to $450 just because it's partially in a flood zone, on top of there was an issue with the egress. So when looking at your deals or looking at investing in others, it's one important number to look at. Management fee, this is the fee to look at for managing a property. So the larger the units, the lesser the management fee. So if you're looking at, say, a 20 unit, I've seen management fees range anywhere from 8 to 10% in the Southeast. But the larger you go, that fee goes down, but you'll have payroll expenses. So it's important to really just make sure, if you're looking in new markets, to just kind of test and see what property management groups are looking at, so that you can make sure you're underwriting, if you're active underwriting. But if you're passive, it's important to just know the rules of thumb in that particular market. Repairs and maintenance, these are the costs to fix up or any repairs. For example, like a hole in the wall, any nicks and stuff like that. It's important. Property tax, this is, I just call right to the tax assessor. It's important to get this number. I've seen a lot of deals, taxes go up at least two times in some markets because the property has been held forever, and the owner wants to just retire. So it's important you understand, and whether you're active or passive, always ask how that person got their number, so that you can understand what that expense will be. And then utilities, electric, water, gas. We generally underwrite 3% increases, but also there's in one of our properties in Lexington, Kentucky, the government said, hey, the water bill's going up 7% just because. For us, we were like, oh no, sticker shock of 7%. We just got this property. But then we realized we can reassess our RUBS number, the utility bill, back, so that we can, recoup those costs. So all in all, long story long, it gets you to your net operating income. So this is the net operating income is the one number multifamily assets are based off of, because it's your net operating income divided by your cap rate, and that's what it's valued at. So it's important to make sure that you're understanding the income and expenses to operate the property. There's no interest from the loan. There's no depreciation, etc. So these are the big buckets to make sure you're keeping an eye out. And does anyone have kind of questions on this slide? Or
Yeah, Mike, there's a question that came in.
yeah.
What costs are the property managers responsible for?
So usually what I've seen, so we're vertically integrated, so I can't, I'm from what I've seen with third party, generally it's the cost of doing business on the property. So their management fee is the paid to them based on collected rents and other income. But what they're responsible for is the management and upkeep. So, depending on the size of the property, they might have a maintenance team come out themselves, or they might have to call contractors to fix it. They also are in charge of leasing up units. But like I said, with the Pulse report, it's important to keep them accountable because uh, I kind of believe no one, if you own it, you care about it way more than they do. So it's important to keep them accountable by reviewing documents like the pulses and getting those weekly check-ins and rhythms so that they can keep it forward. Does that answer? Is that any other questions pertaining to this?
Nothing in the chat room so far, but if you have questions, keep putting them there and we'll pause.
Or if you can unmute yourself. Well, we don't bite here. Cool. So yeah, this is just the income statement. I know it's a lot, but the biggest thing, kind of if you're new, you want to see the income that's pertaining to the property and the expenses pertaining to it. Anything else outside of that, it's like the renovations, we're not as concerned about because those are the upgrades for the property that will eventually trickle in with an increased income and reduce expenses. So this is the budget versus actual. So everyone loves talking about budgets, but this is actually where, I think given everything going on, this is where the real money is made. And I think one of our properties this past year that we've owned, just over a year now, we've cut $1 million in expenses. Mind you, a lot of it was bloated in the sense of they were paying $30,000 for a billboard, and their management team had 5 people, and they've all been in property management for 6 months. But the biggest thing here is looking at what actually happened and comparing it to kind of the budget. So as you can see here, it's just important to kind of see those variances. So insurance, it looks like we overpaid 1 month or we got a refund check, but it's really important to see just the dollars and cents variance and also the percentage because something could go up quite a bit, but there's no, it's a very small fraction of a percentage. So for example, we budgeted for taxes, but they didn't come in. So it's important to get with our accounting team and say, hey, we need to be accruing for this. Utilities, we budgeted for 7,900, but there were 8,700. Hey, do we have leaks on the property? So it's just really important to make sure you're seeing, not just month over month, like period versus actual, but you also really need to understand, is it a reoccurring thing? The biggest thing when you're sitting down with your property management, you might not know, a ton of numbers, but if they're saying the same thing over and over again, like admin expenses, we overspent on admin expenses because we really needed a lot of supplies this month. If you keep hearing that narrative or that account is, constantly getting overspended, take a step back and go, what's going on? Like, what is the problem here? Did we not budget enough money for it? Is it an outlier? I think a perfect example is COVID. I mean, we spend a lot more on our PPE, our equipment to help make sure our maintenance team are safe and our back office is safe. So we spend a lot more supplies this year going in. So it's just constantly, we do them annually. So we're doing them Q4 for next year, but it's just making sure, that what's actually happening versus what you budgeted for, you're looking at it. So as you can, this is a constant measuring stick, and the only way you get better is by measuring it. One thing too I want to hit on is other income. So you can see here, other income is higher. Is it unit damages or is it more move-in fees? Because not other income is created equally. It's important to realize, late fees. A late fee is good, but a move-in fee is better because you're getting a new resident in, right? So not all other income is created equally, but it's important to realize what type of other income is coming in. If people are beating up the place, then you're going to have more renovations and turns and expenses on. So it's just important to make sure you're getting keeping the integrity of the entire community by keeping it through and through. And that next is the rent roll. So I think the biggest thing here is, and a lot of offering memorandums, which are what brokers send, they'll show the physical occupancy. So who is physically there? So it's important. So if I have 7 of 9 residents in, that creates a 78% physical occupancy, which isn't great, especially for agency debt. But if one person doesn't pay, then your economic occupancy is 67. So a lot of things we're getting with brokers is asking for collection reports and seeing what the economic is. I think when you see those offering memorandums, they'll showcase the physical, but when it comes through, it's important to see the economic. And then too, from here, I kind of got a glimpse from one of a rent roll I saw underwriting. It's important to see, for those who are active or even passive, seeing this balance on the rent roll. As you can see, this person owes $2,000, which is approximately, I can't see the total rent, but so it's like a couple months rent if you add these numbers up. So when you're looking at properties, how many months later they due? Obviously, with the CDC moratoriums and the ever-changing rules, you just want to know what you're buying into. And so if everyone's paying late on time, then it's, you have to make sure that you can get enough rent to come in. So it's just important to make sure you know what your pain point is on how many residents are paying versus not paying. I see a couple questions chiming in, so just want to make sure we hit those. Or does anyone have any questions regarding physical economic occupancy or anything else so far?
Quiet crowd today.
Say that again, Daniel.
Oh, I just said it's a quiet group today.
Okay, I saw a couple questions.
Yeah, do you need me to read those off?
Yeah, or you can. Where can I see?
If you click on chat, which should be on your left or your right sidebar. But the question here is, it's rather short. I'm not sure I quite understand it, but it says accounting systems, and then it lists 3 of them: Buildium, Tenant Cloud, AppFolio.
Sorry, I split that in 2 questions. It was for accounting systems. What type of systems generate these reports? I capture some names like Buildium, Tenant Cloud, but I don't know if I have them correctly.
So this one I just know is from Yardi, just because from seeing it a lot. But all the accounting systems that, like QuickBooks wouldn't have this, but a Buildium should have a rent roll. AppFolio should have rent rolls with balances. It's just every, when you see enough of rent rolls, they're very specific in what they look like. But I would guess this is Yardi because it's just how it looks. But any accounting software that you have that's real estate related should have a rent roll feature and the balance column.
Thank you.
Yeah, no problem. Any other questions? And Danny, I don't know why, but I'm on a I see it. Here's the chat. Found it. The next question, when you said overpaid in property tax, is this the budget versus actual side? What argument did you use to reduce it? So for that question, we can estimate what the taxes are, but sometimes they might reassess. So when you buy an asset, they might not change right away, but then the next year it might adjust. So in this case, it might just been a timing in what we've escrow versus what we're, it might have been a correction in escrow. So what we budgeted a year ago might have matched the escrow, but our escrow might have course corrected. So it just depends on timing. We actually use we just partnered with Ryan to assess and fight our assessed value for property taxes to help reduce those. We just started that relationship, so we can't say the success rate. But we're excited, and I can kind of follow up with that once we kind of get rolling on that piece. And then what you can do. So the next question is what you can do if a renter doesn't pay but refuses to leave. So I'm going to preface this with every state is different, so it really depends. Tennessee has been more landlord friendly. Kentucky has been a back and forth on what you can and cannot do, and it's been flip flopped and changing. So generally, what happens is we'll go to the courts and let them know that we're filing for an eviction. If they don't show, then we have a writ in which we then tell the sheriff's department that we're taking action on the eviction. So that's kind of the more the case. Obviously, we don't like to do that, but it's when you have 1,600 units, a lot of stories happen. So it's just unfortunate, but that's kind of the normal case scenario with the CDC moratoriums and everything going on with the pandemic. It's been a lot more. There's a lot of declarations, and the residents have to prove out that they've been affected during the pandemic. But that's the cool part in this real estate world is you could have been doing this for 30 years, or you could have just started yesterday. And we're all kind of in the same slate of trying to figure out the rules very quickly, studying. We've been having the Corona task force with our property manager, where we're huddling in, seeing what lawyers are saying from our teams to help us. So it's been really cool to kind of see our team bond together and trying to, provide as much service for our residents, but also learn very quickly what's going on. And we've helped our residents and even our passive investors who have deals with the communications as well. Any other questions so far, anyone? Feel free to unmute or type them in the chat.
I have one question. I don't know if it's out of scope, but you have properties in different states, right?
Correct.
So how do you handle that in terms of, do you have an LLC in each state, and do you have a central LLC that kind of it's a bigger umbrella to that?
So every property has its own LLC, just because they're different structures. So each property would have its own. For asset protection, we have for example, one syndicated property will have different listed investors, and we want to protect them. Versus a different syndicated property in Kentucky, even though it could be across the street, might have a different set of investors. When it comes to asset protection, you kind of have to do a cost benefit of every house. If you have single family homes, if you have apartments, how much risk are you willing to have? But we also have an umbrella policy for all of our properties as well. So it's just important to kind of, every case is different, but for us, we want to really make sure each asset is protected as much as possible.
Okay. And what does syndicated mean in this case?
Syndication. So for us, what we do is we will get a property under contract, and then we raise it with a 50. We've been 506B as in boy. So with our internal network of investors that we've had, we have about 100 active investors or so. And so we'll reach out to them and say, hey, everyone, we have an opportunity for you to invest. 506Cs and CAT is where you can send it off into the ecosphere of social media and the world. And as long as you're an accredited investor, which there are, I believe, new SEC rules on what that means. So it's that syndication is just generally the act of raising money. So that's how we do it. Generally, we're 70%, 70-30 split, 70 going to our passive investors and 30% going to our general partners who are active on the deal. Does that make sense?
Yeah, thank you.
Okay.
Thank you.
Yeah, absolutely. Any other questions on this? I just want to make sure we're not losing anyone, especially on a Friday, talking deep in the numbers. So just want to make sure.
I'm not sure if we addressed this question or not, but there's a question about is umbrella policy the best way to protect your property?
So we have policies on each property because each property is has its own, for one property, it's in a partial flood zone versus another one isn't. I think in the instance for our case, we have a blanket policy where it has to check the certain boxes of what kind of electrical is it. Is it the best way? I can't speak, every case is different, but we leverage an insurance broker we've had a long-term relationship with who's protected all of our properties. The firm is TIS. They do nationwide, but it's just making sure on the front end you're getting the right people in place to protect you. We have an internal mortgage broker as well, because when you're, say you're trying to do 1 or 2 deals a year, the financing world can completely change like for example, with COVID, it stopped, it's back on. So we leverage brokers to help us with our financing and our insurance, just to continually keep, because they're looking every single day at the the markets and what's going on, or rates going up or down. So I'd rather have someone who's seeing it every day versus me try to own one more thing and have that I'm a do attitude of I'm going to do everything to make sure we're executing. So it's really important to do that. So I see another question. What is the process and qualifications for qualifications to be a passive investor? We generally, we start up a conversation, at the end we can connect, and we generally schedule time, and I want to, we vet to make sure our goals align together. And I think too, as a passive investor, it's important to make sure your rhythm requirements match what you expect, because in a syndication, your first time, you're investing a large sum of money to invest. And if you never hear from them again, it's kind of like, what did I invest in? So, but for us, we do monthly webinars the first 3 months. Then we do quarterly webinars and provide monthly statements. So like I said, kind of like with this presentation, it's important to know your rhythms back and forth. But I'll have my email address, and we can further talk and I'll share it with everyone. So if anyone has any questions. I see WHC Wong. Is landlord insurance the right type of insurance, or is it other type of insurance that should be considered? So for that one, I'm not too sure. Like landlord, we have the property insurance, and it's important to have, any down reps, lost revenue. We have renters. We make all of our residents have renters insurance as well, because say someone, could steal something, or we had a 2 units had a fire because someone left the stove on. Anything can happen. So it's like a true insurance answer. You want to protect your assets, and it's super helpful. When you have everyone have renters insurance, you're protecting from the inside, but also anything that can happen outside. So we just make sure everyone's insured as much as possible for their goods, but also for our property as well. So it's just, I think that's, I don't know. That's the best I can answer that, unless there's any other specific questions when it comes to that piece.
Do you get sued often, and do you have your own team of lawyers, or you outsource that?
We haven't been sued, and we don't. I mean, we have to have lawyers. We don't have lawyers on staff, but we have partnerships with locals. But we don't we don't get sued. We take pride in being a resource for our residents and helping them as much as possible. And knock on wood, we haven't had an insurance claim. So it's been super helpful, and we've it's just helping a resource for residents and educating them how to protect themselves, but also just when it comes to just helping people as best as we can, that's what we look to do.
Oh, thanks.
Yeah. So this is kind of insight of a budget. So it's important to kind of generate, what is the main driver of this account? So gross potential rent, we're looking for occupancy. We're shooting for 98% for this particular property. We have vacancy. This year, we really dialed in our delinquency numbers to see what's, what our percentages is, and so we can sharpen the pencil and really help. But not even then. So pet fees are $25 per month, but we're assuming about 40% of the residents have it. So, this is how granular we go every year. And some property managers are not the most numbers oriented, especially with my background, being a CPA. I've worked with startups under the Dan Gilbert umbrella, and just helps, teach people to know the numbers. I compare the analogy to Shark Tank. I wouldn't invest with someone if they don't know the numbers of their business. And that's what property managers are. They're the CEO of that property. So we just kind of go through line item by line item for income. So this is our RUBS: sewer, water, gas, pest. But late fees, move-in fees, vending income, we're just going line by line and going to see what drives that account. So unit damages might be averaging 1,000, but then we find that might be higher for that property. Lease terminations, we're seeing a lot of, it's 2 months rent. So why are we having more terminations on that piece? Why are people breaking the leases? Is it the customer service? Is it the location? And we ask those questions just to make sure we're measuring our net promoter score, which is a score on it's two questions on a scale of 0 to 10. How likely would you recommend staying in a rent property? And from there, it is 75 is the equivalent of like an Apple when it comes to customer service, and we have about a couple properties that have scored that 75 or been just close. So it's important to measure your customer service, but also your numbers as well, and see that. But it's important to just breaking it down for how much income are we coming? What is our average occupancy? How many people have pets? How many people pay late? How many move-ins? I think this one's been an interesting number because last year, going through the budgets, people thought only 40% of the people move out. But going through it, we've seen more people move out. So we had more move-in fees because it's just seeing that conversion. See a question coming. Why is SWGP income? This is income because this is how much our residents are paying us for the sewer, water, gas, pest. Every market's different, so this might not be the case in particular markets, but in our East Tennessee and Kentucky markets, we've seen billing back for utilities is an income line item, and that goes against the utilities expense, which we'll see in the other piece of it. And then I see what do you do when renters break lease, pay for the remaining months, or pay for a couple months versus pay nothing? So for when a resident breaks the lease, it's in our contract that they have to pay 2 months ahead of time. It's a 2-month penalty for breaking the lease. So we charge that on the front end. Obviously, so that's just making sure that we're getting the income, but also giving us enough time to turn the units. The next question I see is, do you also track the average tenure of a typical lease? We AppFolio in this case doesn't do the average tenure. We're looking at how many we're comparing how many leases end versus how much are renewing. Average lease, it's across the board. You will hear stories of people have been there since we've first taken over the property. But I think truly with our RAM property management, if I had to guess, it's a couple years average. And we, in a lot of cases, we'll see someone leave one property and go to another. So it's the biggest thing when it comes to your income and expenses is how many people are not renewing. Because, for example, if someone stays an extra year, you save money on doing the floors, the painting. When someone stays for longer, what we'll do is hey, what upgrade would you like of these upgrades? So it might be a new faucet or different lighting or maybe a little upgrade. So it'll be cheaper than to turn a whole unit. And if you keep them for 2-3 years, you're saving thousands of dollars for a resident who's paying rent on time. Next question I see is, what is the percentage of ROI for passive investors in your firm? We're generally looking, we're shooting for 8%. We do an 8% preferred return. We're looking for probably around a 15% IRR, which is a cash on cash versus 15 to 20 IRR on every deal. Right now, we haven't done a lot of deals because we're just looking to, but these are our guidelines of when we're looking. So those are kind of our guidelines for it. How do you handle pets cause more damage than the security deposit? So we don't do security deposits, but what we do is we do in either we charge $300 for pets on the front, or it's $150 now and then $25 per month. So it's the pet fee plus pet rent. So that's important to because we don't charge the security deposit, but generally we've seen our residents. Most of our residents take care of their pets in the living situation, so it's not as bad. But we've been in some units where it's not as nice and it's a lot. So another question I see is, what would you do if tenants are not capable of paying rents during COVID? So we were averaging communications every other day during the pandemic at the beginning, making sure we're helping residents, whether it's rental assistance, whether it's a payment plan. In Louisville, the neighborhood place has been a phenomenal resource. We've helped our residents We want to keep the integrity, but of our communities, and so we just want to make sure that we're educating our residents as much as possible. So we've done the toilet paper campaign, and we've had a lot of good success with it. And we're understanding of people, and everyone has a story, but it's kind of like I said, the feedback. If residents just ghost us, it's we're doing everything our can, whether it's reaching out to them, local employers who are helping, rental assistance programs. We're providing everyone the resources to help them in their time of needs. Or we had a lot of people who needed help and going through it, so we're just going, helping as much people out as we can. For the properties you acquire, what is the debt equity split? Generally, our loan to value on our deals is 75% loan to value. So we're just looking. So that's kind of the leverage we use. We haven't seen, sometimes we'll see 80, but generally our sweet spot's around 75% loan to value. So I want to go through. Oh, go ahead.
So I had a question there, just on the SWGP. So you said East Market. So is this like so two questions really. Is the idea of viewing SWGP as income to avoid having to pay like a utility balance once they move out, by kind of build up an escrow account, or is it like a co-op where I'm from New York, so they have co-ops where it's part of the maintenance fee is a utility, so you don't really kind of pass the specific bill to each tenant. You sort of aggregate it.
Yeah, so it's like, so we take the full kind of bill package, utility package, and then we divide it by total units, and we're like, okay, for the 1 beds they pay, we'll say $40 a month, 2 beds 50, 3 beds 55. So this is just to kind of recoup our costs on the utilities because they're not individually metered.
Got it.
Yeah. So, and then you said you had another question.
No, I think you answered it in a sense that this is a phenomenon for the topic of multifamily of a certain size, where you aggregate, you sort of aggregate the cost. So I think you answered it.
Yeah, and you can do this as long as you're not individually metered. But if you're looking for properties, we just looked at a property yesterday, and the rarity that it's individually metered. So don't expect that income to be there on every property if it's individually metered and has to have the resident statement. So it's important to kind of know what you're buying into and the capabilities of the property. So gonna go through the expenses and make sure we get through it, because I think it was just last slide, and then we can go open up for Q&A. But like I said too, these are important. The expenses are also important. Like I said, for our property in Lexington, it's important to make sure you know the driver of it. So like apartment cleanings, these are going to be your per move outs. Carpet cleanings per move out, equipment expense. These might be the bigger projects that you don't have the tools for. It's harder to, water extractions pop up, but it's hard to, you can't assume it'll never happen, but it's important to make sure you are budgeting for it. Safety and security. We use this account not just, we use it because we have water, fire hydrants on the property, fire extinguisher checks. So it isn't necessarily security. This is just more of a safety line item that we use just to make sure, inspections and whatnot. Like I said, we talked about taxes, but these are just kind of what we've been escrowing. And then to E.G. Walter's question, here's what we see on we're averaging per month on utilities. Obviously, we'll see some spikes of just in the winter months, we might have higher bills, but it's important to just make sure you're keeping them in check. I think trash is for those who do have syndicated or multifamily properties, this is a bill that generally, if you call, the contract can go, you can knock down on the price. And we've seen a lot of people, a lot of contracts get lowered, but also we've seen a lot of price creep as well. So it's important you have these budgets so that you can really monitor, hey, every month I know it's going to be $407.16. So just making sure you review your bills and see what's going on at the property every day. And then we're always striving for that NOI number. I see a couple questions on here. Post passive investment. What are your exit options? So generally, we're taking, we assess a sale or refinance. We don't refinance out our investors. We want a long-term cash flow generating asset for everyone. I know other groups have different stances on it, but for us, you've invested with us. We're a fiduciary to you as a passive investor. So we assess a refinance or sale. Jake and Gino have generally done a longer term approach when it comes to it. So it just depends on the asset, the market, what's going on. But we always reassess both and see what's the best for everyone. And if cash payout requested is a pre-agreed appreciation include as if cash payout requested is there a pre-agreed appreciation included as part of your payout? Generally, it's a 70-30 split through and through. So we have, if our 8 pref, the LPs get the 8% preferred return. And then from there, it's a 70-30 split of the sale. So I think that might answer that question. And I see Hadi's question. These numbers are for how many units? I forgot which one these are for. I took a budget that I had open one day, so I don't have the units. But we average, we do all our budgets, whether it's 20 units or 240 units. So it's just important. Each property has its own budget. And as a macro, you can kind of see and showcase what the macro trends and the micro trends are at property, because older properties are going to have a lot more issues than a newer property, and it's like a 60s asset's going to have rougher plumbing than a 90s asset. So it's just important to kind of see the trends when you're looking at it. But yeah, I'd love to open up to Q&A. And if anyone has any questions too, Gino, Barbaro, let Daniel, if anyone has any questions or wants the wheelbarrow profits, we can send them a PDF copy if you reach out to me, Mike T at Ransiri. Let me know you're part of Daniel's amazing group, and I'm happy to share the free PDF copy, or I can send it to you, Daniel, as well. I'm just happy to, help serve, and I'm happy to open up to any other Q&As or to anyone has any questions.
All right, we've got 2 minutes left for any questions.
Daniel, do you have any questions?
I don't. I usually tend to try and keep my mouth shut and let other people speak.
I have a question regarding pet rent. It's just honor system, or you have people that could possibly sneak in pets, and then also, my second question escaped me, so I'll let it go.
So we generally ask on the front end, and then follow up. So I think it's just making sure, like, say for it's honor system, but if you have to go in and like a maintenance person has to go in and see if there's any pets in, we always ask, is there anything we need to be aware of? So that's kind of how you can kind of tell if we have pets. Don't tell my property management, but I just rescued a kitten last week, and it was the most cutest thing ever. So I haven't paid the pet rent.
Okay, I realized my second question now was about the insurance. Renters insurance. Is this just something that you have in the lease agreement, or do you actually verify?
We have in the lease agreement, and we do verify. Probably after 30 days, we double check, or 15, 30-day check-in. We're verifying that they have it on file as well. We looked at having our own insurance, our captive insurance, but it's hard enough being multifamily operators, let alone multifamily operators and an insurance company in one. So we elected not to do it, but we have it on the front end and in the agreement. And if anything were to happen, we kind of just follow the agreement and the lease.
Thank you.
All right, Mike, we're out of time. Thank you so much for coming in and sharing with us. Those were great, seeing all the actual spreadsheets and budgets that you had there. So We'll put all the information, your contact information, in our internal group, and anybody who wants that PDF, reach out to Mike. And I suppose, Mike, do you want me to post that internally also, or would you prefer people just to reach out to you?
Yeah, if people want to reach out to me, like I said, Mike T at ransiri.com, I'm happy to, and I can send it to you, Daniel. So if people don't reach out, I'm happy to do so as well. So
okay.
But thank you so much, Daniel. Thank you, everyone, for having me on. And I hope you have a wonderful Friday, safe and happy Halloween, and a better weekend.
Thank you.
Have a great weekend.
You.
It was
Appreciate it.
great. Thank you so much.
You're welcome. Thank you, everyone.
Thanks.